Today we're going to talk about something quite interesting, which is called balance of payments. And this is something that you haven't seen before. It's new stuff not covered in Intro to Economics. Um, just to remind you, as we go through these videos, you must take notes. And it's a good idea to record this slide number, which is at the top left corner. Anything that's written on the screen, you must write it down in your notes. All right, now if you want to elaborate more, or if you want to use contractions, shorthand, whatever, do it your way. This is for yourself. You're going to have to show it to me later, but you have flexibilities really for your own learning. So feel free to pause anytime, go back, write down notes as we go through. Alright, so the way we define balance of payments accounts is the report of all sales and purchases between Canada and the rest of the world. This, by the way, is between. So if you've done any accounting before, you would have heard of debit and credit. This is the way we classify our purchases and sales or transactions. So a debit would be a negative and a credit would be a positive in terms of how the transaction is recorded. So a debit would be when Canada purchases something from foreign countries, or when there's a capital outflow, which is when financial capital leaves Canada. Financial capital, you can think of it as funds or financial assets. It's basically when we purchase something, so we have to pay others. All right, so that's due to a purchase by Canada from other countries. The opposite would be when Canada sells something to foreign countries. Or capital inflow, which is when financial capital enters Canada. And that's due to a sale by Canada. All right, so pause here and write down your notes. When we talk about the balance of payments, we have a classification of current account versus capital account. CA represents current account, KA represents capital account. Well, that should have been C also, but the C is taken, so we use K. In economics, capital is represented by K. It's kind of like German. Anyway, so what is the current account? The gist of the current account is that it's really about income, which is a form of a flow, as opposed to capital account, which is about wealth, and that's a form of stock. If you remember, the difference between income and wealth is that income is a flow. It's an ongoing set of transactions every month, every 2 weeks. Whereas wealth is something accumulated over time. It's kind of like a storage. So as we go through these current account, capital account, it's easy to mix between them. But what you have right now on the screen is a good point of reference. So current account, when we talk about current accounts, really about some form of an income, a transaction of income, whereas capital account is a transaction of wealth. One type of current account is a trade account, which represents the payments and receipts arising from imports and exports of goods and services. So for instance, if we import something, it means we are buying a good or service from a foreign country. If we are buying, that's going to be a debit transaction. Another type is capital service account, which represents payments and receipts arising from income and assets. So what is that? For instance, a Canadian company pays dividend payments to foreigners. Okay, now if a Canadian company is paying, that would be, is that a debit or a credit? That would be a debit. All right, so to summarize the current account, you really have two main things, either goods or services or income and assets. All right, so that's the idea here. Capital account, one type of it is payments and receipts arising from the purchase and sale of assets. For instance, when bonds, real estate, shares of companies or factories are bought from the foreigners. If you're buying something from foreigners, that would be a debit. By the way, this word assets in economics, here are examples of assets like bonds, real estate, shares, factories. Okay, so these are examples of assets in economics. Also, don't mix between this number 1 here and the number 2 that you read before. Number 2 of current account was income and assets. specifically, not the assets themselves, but income and assets. Whereas number one of capital account is the assets themselves, and that's why it's the form of a stock or a wealth. Another type of capital account is official financing accounts, which is changes in the government's foreign exchange reserves. Okay, so the government basically has a reserve of foreign currency, and sometimes it may decide to increase or decrease that. So if the government increases its reserves of foreign currency, what's going to happen? Well, if they're purchasing something from foreigners, it's a purchase, it's a payment, so that's going to be a debit. All right? So the two main items in the capital account are assets and reserves. To sum up all of this mess, what you have on the current account would be goods and services and interest. And what you have for current capital account would be assets and currency. So I think what you have, the last line of this slide is quite a useful summary of all this. When you get a question on current account, really it's about either goods and services or interest payments. If you're talking about capital accounts, really about assets or currency. So pause here and write down your notes. The balance of payments accounts are defined as current account plus capital account, and that should equal 0. All right? Or CA plus KA equals 0. So that's a useful formula. When you write it down, highlight it or box it because it's going to be useful. And that's the idea of a balance. So it should always, the two sides should always match and add up to 0. So here's an example of why this is true. This is quite an intuitive and logical identity or balance that we have. So here's an example of why this is. Let's say Canada exports $160 billion and it imports $90 billion. All right. So first of all, what is our trade balance? Trade balance, which is the same as net exports, is exports minus imports. In this case, exports are 160, imports are 90. So 160 minus 90 would be $70 billion, and that is trade surplus because it's positive. All right, so it means that we have a positive current account. Now, what does that really mean? What it means is that Canadians have claim on foreigners equal to $70 billion because we have sold more to them, so we have some claim, some positive claim over them, equaling $70 billion. What are we gonna do with this claim that we have? We have really two options. One of them is that we can buy foreign goods and services. Remember, it's kind of like they owe us, right? So we can either buy, you can use this excess that we have to buy their goods and services, or we can buy foreign assets. We can instead of buying goods and services, we can buy their assets. We can buy land and homes and factories in their country. If we buy foreign goods and services, it means that our imports would go up, which would be a debit on the current account. If we buy assets, it's going to be a debit on the capital account. Both are outflows, which would be a debit. So it's effectively going to be a negative 70 somewhere, either in the current account or the capital account. A surplus in the current account is matched by an equal deficit on the capital account. All right, just because of the simple reason of the way these transactions work. If you buy more from them, it's kind of like we're getting their currency. What are you gonna do with the currency, right? If we export a lot of things to, let's say, Japan, we get a lot of Japanese currency, yen. What is yen good for? It's good for either of these two things. It's either good for buying their goods and services or buying foreign assets. So either way, it's going to cancel out by the end of the day. So write down your notes. All right, the exchange rate, symbolized by small e, is how much domestic currency is required to purchase 1 unit of foreign currency. So how many Canadian dollars do you need in order to buy 1 euro or 1 pound or 1 US dollar? It's really the price of foreign currency, and that's important. Exchange rate is the price of foreign currency. And the units of it is Canadian dollars per foreign currency. I use this FOR as a generic representation of any foreign currency. So you can say USD, you can say euros, you can say whatever. Okay. So here's an example. Let's say the E is 1.21 Canadian dollars per 4. What it means is that you need $1 Canadian dollar and 21 cents in order to obtain 1 unit of foreign currency. Let's say 1 unit of American dollars or 1 unit of euros. If Canadian dollars is strong, it means there is going to be a low exchange rate. Remember, exchange rate is the price of foreign currency. This is a little bit counterintuitive, okay? Depreciation means when the domestic currency becomes less valuable, all right? If it becomes less valuable, it means it takes more Canadian dollars to buy one foreign currency. So what's happening to E? If you need more Canadian dollars to buy 1 unit of foreign currency, it means the E is going up. That's why it's a little bit counterintuitive. So you really want to watch out here. It's a little bit tricky. If E goes up, it means the Canadian dollar depreciates, whereas the foreign currency appreciates. But if the Canadian dollar appreciates, then the E is going down. So it's really a relative measure. It's always reciprocal. If one currency appreciates, the other one depreciates. All right. The definition given here for exchange rate, sometimes in some books they give exactly the opposite. So instead of saying the price of foreign currency, they say that it's the price of domestic currency. But for this course, we're going to go with this definition that we have, and it is more consistent. Okay. So pause here and write down your notes. Here's something cool and useful, the foreign exchange market. If you remember, whenever we have a market, we are talking about buyers and sellers, which means supply and demand. And we have the quantity on the horizontal axis. In this case, we are talking about the quantity of foreign exchange, the quantity of foreign currency. So if you don't remember what is Q, write out quantity. And on the vertical axis, we have the price. In this case, the price of foreign exchange, which is the same as the exchange rate. We have an upward sloping line, which is the supply, and a downward sloping line, which is the demand. Now notice that in this diagram, everything is about foreign exchange. Everything is about the foreign currency. It's not about Canadian dollars, it's about the foreign currency. So we're talking about the supply of foreign currency and the demand for foreign currency, the quantity of foreign currency and the price of foreign currency. Everything should be consistent. The point of intersection is called E, which is the equilibrium. All right. Sometimes you get, so this is really just any kind of supply and demand diagram. It's just that it's applied to the foreign exchange. Sometimes you get questions about shifting the curves, and the rule for shifting is very simple. Whenever you have an increase, you shift the line to the right. Whenever you have a decrease, you shift the line to the left. That's always the rule for any supply and demand diagram. So write this down, draw the diagram in your notes. We're going to watch a funny clip next. It kind of makes fun of Canada, but it's kind of interesting. You don't have to write notes in the clip.
It's only fair. We went to Europe when Lisa lost her balloon.
Maggie, what do you think?
All right, son. We'll all go. First class.
It's so clean and bland. I'm home.
Wow, this bus station is the birthplace of Paul Schaefer. Dad, no, it says don't walk.
Doesn't matter. They have free health care. Whoa, I'm rich!
Take off through the great big door. Take off. It's a beauty way to go. Take off.
I'm a 10-year-old boy in Toronto. I should be the happiest kid in the world. But I can't stop thinking about Greta.
Oh, you'll win her back, eh? And B, we're closing in 5 minutes.
Would a U.S. dollar change your mind?
American currency! What time would you like your breakfast, sir?
Take off through the great big door.
Over there, you can see them shooting the film Canadian Graffiti.
I see a drive on the left up here.
No, ma'am. I'm drunk.
The foreign exchange market is just like any other market with supply and demand. So let's look at an exchange rate which is above the equilibrium rate. Now remember, the exchange rate is the price of foreign exchange, is the price of foreign currency. If the price of anything is high, what's going to be the level of supply and the level of demand? If something is expensive, there's not going to be many buyers, but there's going to be a lot of sellers, right? So if you want to work with this in a graph, you would have to draw a horizontal line at your price level, in this case E2, and then you find the corresponding quantity demanded on the demand curve and the corresponding quantity supplied on the supply curve. All right, so at E2, which is above E1, above the equilibrium exchange rate, there is excess supply of foreign currency, but not enough demand for all that foreign currency lying around. What is it called when you have too much supply but not enough demand? Surplus, right? So you can show a surplus graphically in any market, including the foreign exchange market, by looking at the distance between the supply and the demand curves, right? So Fx here stands for foreign exchange. Now, how can the sellers sell their extra foreign exchange? They have a lot of supply, but there's not enough demand, right? If that's the case, they'll have to accept less Canadian dollar in exchange. So they will have to accept a lower price in exchange for their product, in this case, foreign exchange. And that's why the exchange rate is going to drop gradually. Okay, so we're going to approach the equilibrium, and E2 is going to approach E1. So the exchange rate is going to drop, which means the foreign exchange depreciates, whereas the Canadian dollar appreciates. Okay, they always move in the opposite directions. Now let's look at an opposite case, say E3, which is lower than the equilibrium. Again, think of it. If something is cheap, if foreign currency is cheap, there's going to be a lot of buyers for it, but not enough sellers for it, right? So again, you can draw a horizontal line. You find your quantity supplied and quantity demanded, and you can tell that at E3 there is excess demand for foreign currency, but not enough supply, right? So that's called a shortage, and graphically that's just the distance between QS and QD. All right, so you should be able to show graphically what is a surplus and what is a shortage. How can a buyer get hold of foreign exchange? If somebody wants to buy foreign currency, how can they get it? Well, if they really want it, they have to pay more for it. So buyers will fight over the limited supply by offering more Canadian dollars in exchange, and that's going to drive up the price. It's going to drive up the exchange rate, and when E goes up, it's going to approach the equilibrium, so foreign exchange appreciates and Canadian dollar depreciates. So take a minute, write these down, draw a nice large diagram for yourself with all the arrows with the surplus and the shortage. Talking about the market and the supply and demand and shifting the lines, we're going to focus right now on the supply of foreign currency. But one useful tip here is that the supply of foreign currency is exactly the same as the demand for Canadian dollars. All right, that's an extremely useful and important idea to keep in mind, right? Remember, there's always this reciprocal relationship between one currency and another, right? So if there is a supply of foreign currency, it corresponds to a demand for the other currency. There's an exchange. So one source of supply for foreign currency is if the foreigners want to buy Canadian goods and services. If they want to buy our goods and services, what kind of currency do they need? They're going to need Canadian dollars, right? How do they get Canadian dollars? They'll offer their foreign currency, their own currency, in exchange. That's why the supply of foreign currency is going to increase. All right. So in this case, you would shift the supply curve to the right because it's an increase of the supply of foreign currency. So one example of that would be Canadian exports, cars, lumber, tourism. If they want to purchase any of these goods and services, they will have to offer their own currency. Another example is capital inflows. Capital inflow is when foreigners want to purchase Canadian assets. If they want to buy, so assets, remember bonds, shares, real estate. If they want to buy our assets, what kind of currency do they need? Again, they need Canadian dollars. How do they get Canadian dollars? by supplying their own currency. All right, so exactly the same dynamic applies in the case of assets. Or let's say foreign banks and governments want to increase their reserves of Canadian dollars. Let's say for whatever reason they think that the Canadian dollar is valuable, it's going to increase in value in the future, so they would want to invest in it. If they want to buy Canadian dollars, what do they have to offer in exchange? Well, they will have to offer their own currency, and that's why the supply of their currency is going to increase. So for instance, when foreign investors predict that the Canadian dollar will appreciate in the future. Another example is if Canadian banks and governments reduce their foreign exchange reserves. Okay, so if our banks and our government don't like to keep foreign exchange reserves, what happens is that they're going to supply their foreign exchange for sale. So there's going to be an increase in the sale of foreign exchange. All right, so if there is an increase in the supply of foreign currency, there's going to be an increase in the demand for Canadian dollars and vice versa. So these two always go hand in hand. More demand of Canadian dollar is the same as more supply of foreign currency. Okay, that's extremely useful. So write these down. This is similar to what we just saw, but this time about the demand for foreign currency. And the demand for foreign currency is the same as the supply of Canadian dollars. Again, it's kind of like this mutual relationship. So one source of demand for foreign currency is Canadian imports. If we want to buy their products, we need their currency. Okay, so if we need their currency, it means more demand for foreign currency. Again, if you have a graph, you will shift the demand curve to the right. So we are going to offer our Canadian dollars in exchange for foreign currency. One point which is quite important here, remember guys, the whole focus of all this mess, the focus is foreign currency. The focus is not Canadian dollar. It's the foreign currency. That is at the core of the discussion. Or Canadian investors want to buy foreign assets. Again, assets kind of like stocks, bonds, real estate. Well, we'll need their currency if you want to buy their assets. So this basket here shows a bunch of different types of assets like property, funds, retirement plans, equities, shares. Another example would be if foreign banks and governments sell their holdings of Canadian dollar. If they're no longer interested in the Canadian dollar, they're going to exchange their CAD for foreign currency. So they're going to have a demand for the other currency. Another example is if the Canadian banks and government increase their foreign exchange reserves. So if they decide to hold more of foreign currency, well, that's going to be an increase in the demand. All right. Again, if there's more demand for foreign currency, it's the same as saying there's more supply of Canadian dollar. They go hand in hand. So take down your notes. Okay, I'm going to give you something very useful in terms of doing questions later on. We're going to have a table which is going to summarize all these supply-demand stuff. And later on, when you do graph questions, this table is going to be a very useful point of reference. So we're going to divide things into inflow and outflow. All right. One example of an inflow of funds to Canada would be Canadian exports. We sell goods to them. We receive funds from them. Funds would be either Canadian dollars or foreign currency. The opposite of that would be Canadian imports, where there is an outflow from Canada. An inflow would be foreign investment in Canada, so foreign investment in our assets. An outflow would be Canadian investment abroad when we invest in their assets. An inflow would be Canadian Central Bank, which is a CB, or the Bank of Canada, reducing its reserves of foreign currency. So it is selling foreign currency, which means it's receiving Canadian dollars. An outflow would be the Bank of Canada increasing its reserves of foreign currency. An inflow would be foreign banks and governments buying Canadian dollars. An outflow would be foreign banks and governments selling Canadian dollars. All right. Now, whenever there is an inflow of funds to Canada, that's the same as supply of foreign currency. It's the same as demand for Canadian dollars. Whenever there is an outflow of funds, it's the same as demand for foreign currency or the supply of the Canadian dollars. All right. Now, just to review our current account and capital account, what is the first one? If you look at exports and imports refer to goods and services, so that would be current account. Whereas investment in assets would be capital account. The third one, Canadian Central Bank reducing reserves is also capital account, and Canadian dollar is also capital account. On the other side, we have pretty much the same thing. Imports would be current account, whereas investment on assets would be capital account. The reserves of foreign exchange would be capital account, and Canadian dollar would also be capital account. All right, that's just based on the definition. So pause here and write down your notes. Every central bank, like the Bank of Canada, would have some exchange rate policies. All right. One type of policy which we have actually, and pretty much all countries have, is called flexible or floating. Those are two names for the same thing, and you should know both names. And that's when the exchange rate is free to move. Okay, so it's floating. Oh, isn't that cute? Whenever I see these pictures like this, kind of feels like child labor. You know, they're kind of abusing the cuteness of the child to get some publicity or whatever. Anyways, that's the flexible exchange rate. It's determined by supply and demand of foreign exchange. So the central bank doesn't dictate anything. It doesn't determine the value of the currency. It just lets it flow and be determined by the supply and demand. There is no intervention by the CB. The opposite of that would be fixed or pegged exchange rate. Again, fixed and pegged are two names for the same thing. That's when the central bank intervenes to fix the exchange rate at a particular level, and that's usually is a target range. So it's not an exact number, but it's a range. It has to be within that range. This is what there used to be in the 60s, for instance, but it's really not a smart thing to do, and we're going to look at why not. So fixed is kind of like this poor Winnie the Pooh being fixed and stuck in a certain position. Can't move. Then we have two hybrid models. One of them is called adjustable peg system, which is fixed in the short run, but sometimes adjusted in response to economic events and shocks. So this is predominantly fixed, but not 100%. So there's some level of peg and some long run adjustments. And the other one, which is also a hybrid, is managed float, which is there is no publicly announced target, but the central bank has some stabilizing influence. So overall, it is floating, but sometimes the central bank sends a wave to modify it. Really the main two ones that you want to focus more on would be the first two, flexible and fixed. So pause here and write down your notes.